That mortgage renewal letter from your bank arriving in 2026? Let's be honest, it's not a courtesy, it's a trap. You trusted them a few years back when you locked in a record low rate. Now they are banking on your loyalty to hit you with a massive payment shock. I'm a GTA real estate broker, and today I am pulling the curtains back on the 5-step plan to fight their hidden loyalty tax and potentially save yourself thousands of dollars. What your banks hope you will never find out starts right now. Let's cut to the chase. The era of cheap money that defined 2020 and 2021 is over. If you are one of the million of Canadians who wisely locked in at a 5-year fixed mortgage rate then, you are part of the biggest mortgage renewal wave in Canadian history, and your bank knows it. They saw you grab a great rate between 1.5 and 3%. Now they are preparing to serve you the consequences. The Bank of Canada and other financial experts aren't mincing words. Many households with a 5-year fixed rate mortgage renewing in 2026 can expect an average payment increase of around 20%. Some estimates suggest it could be as high as 20 to 25% payment increase for many Canadian households. Let's translate that into the real world GTA numbers. Say you have a $700,000 mortgage. A few years ago, at a rate of 1.8% interest with a 25-year amortization, your monthly payment was $2,890. Now, let's imagine your bank's first generous renewal offer coming in at 4.1%, a rate that is not competitive in today's market. Your new monthly payment would explode to approximately $3,715. That's an extra $825 a month, and that's nearly $10,000 a year, straight from your pocket into the bank's profit margin. This isn't just a rate hike. This is what we call the loyalty tax. It's the premium you pay for the convenience of not asking any questions. Research has shown that Canadians who blindly stay with their current lender can pay significantly more every month, adding up to thousands over a new 5-year term. Why? Because the banks are betting on your inertia. They know you are busy. They know mortgages are confusing. So they send a simple looking form hoping that you will sign it without a fight. That first offer is almost never their best. It's just their most profitable one. And about 60% of all Canadian mortgages have renewed in 2025 or are up for renewal by the end of 2026. Banks are positioned to make a fortune from their complacency. But you are not going to let that happen. You are here, which means you are already on a path to fight back. It's time to turn the tables and make the banks compete for your business. Here's the 5-step plan to dismantle the loyalty tax and secure a deal that saves you thousands of dollars. Your bank is legally required to send you a renewal statement at least 21 days before the end of term. This is laughably small window of design to create pressure and limit your options. Don't wait for it. The real power move is to set a calendar alert for at least 120 days, a full 4 months before your mortgage matures. This is the typical window where most lenders will provide a rate hold. A rate hold locks in today's rate for you, protecting you if the rates go up, but often letting you take advantage if the rates go down before you sign. Starting early transforms you from a reactive victim into a proactive negotiator. This 4-month period is your battlefield. It gives you time to gather intelligence, shop the market, and negotiate from a position of strength, not desperation. Before you negotiate, you need to know what you are negotiating for, and it's more than just the interest rate. When you contact your bank, start with the renewal process. Ask 3 critical non-negotiable questions. The answers can be worth more than slightly just the lower interest rate. First, what are my prepayment privileges? Can you make a lump sum payment? Can you increase your monthly payment? And what are the limits? A flexible mortgage that lets you pay it down faster on your terms is a more powerful wealth building tool. Second, is this mortgage portable? Portability means you can take your mortgage with you to a new property if you move. Without it, you could be forced to break your mortgage and pay a massive penalty, even if you're just buying a new home. And the third most important question, how do you calculate the interest rate differential, or IRD penalty? This is the hidden trap. For fixed rate mortgages, the penalty for breaking is usually the greater of 3 months or the interest or the IRD. The big banks often calculate the IRD using their posted rates, which is much higher than the discounted rates that they're giving to the new customers. This inflates the penalty immensely. A penalty that might be just a few $1,000s at one lender could be tens and thousands of dollars with the big bank for the exact same mortgage. You must get a clear answer on this. Now that you have the baseline offer from your bank, it's time to go on the offensive. This is where you call a mortgage broker. Think of a mortgage broker as your secret weapon. You work with one person and they shop you a mortgage to dozens of different lenders, including the ones your bank prays you never hear about. Monoline lenders. Monoline lenders are only doing one thing, mortgages. They don't have any expensive branches or other banking products to support. Because of this, their rates are often more competitive, and crucially, their penalty calculations are almost always fairer than the big banks. The difference in the penalty calculations can be substantial, potentially saving you a huge amount of money and stress if life changes and you need to break the term. And don't worry, they are just as regulated by the Canadian government as the other major banks. The best part, thanks to the rules updated for the renewal wave, most borrowers who are just switching lenders for the new term without increasing their loan amount or the amortization don't have to pass the mortgage stress test again. This opens up the market for you. As of early February 2026, the best 5-year rate fixed from the brokers are as low as 3.69 and 3-year fixed rates are at 3.59. Armed with a competitive quote from a broker, you can now have your single most powerful piece of negotiating leverage. You have done your homework, now you have a superior offer from a competitor. Now you go back to the bank. Don't ask them if they can just match it. You contact your mortgage representative and state the facts calmly and clearly. You say, I have been a loyal client for many years. Your initial renewal offer of 4.1% is not acceptable. I have a firm offer from another lender for a 5-year fix at a lower rate than what you have given me, with a fairer penalty calculation. I prefer to keep my business here, but to do that, you need to match this or beat this offer. Then you practice the power of silence. This isn't a social call, it's a business transaction. State your position and just wait. Often, this direct statement is enough to get your file escalated to the bank's retention department. These are the specialists whose entire job is to keep you from leaving. They have access to discounts and rates that the frontline staff don't. They know it costs more to get new business than to keep an existing one, and they will often bend to keep your business. If the banks come back and matches the rate, your work isn't done. Now you compare the two offers. Remember, step number 2 is not just about the interest rate. Look at the fine print. Does the bank's matched offer have the same fair penalty calculation as the monoline lender? Does it have the same prepayment privileges? Is it portable? A slightly lower rate is worthless if it locks you into an inflexible product with a monstrous potential penalty. This is also the time to consider your terms. While a 5-year fixed offers stability, a 3-year term might offer a lower rate, giving you more flexibility sooner. Or if you have the risk tolerance, a variable rate might be an option. As of early February 2026, the prime rate is 4.45% and its best variable rate is around 3.35%, In fact, some holders of variable rate mortgages may even see their payments decline. Choose the product that best fits your financial goal and risk tolerance for the next few years. If you are finding this information valuable, please hit that subscribe and like button. If your renewal payment are going to be unaffordable, or even worse, the banks are not renewing, please give me a call to sell before you get into a financial trouble. So let's recap the 5-step plan. Number 1, start 120 days early. Number 2, gather intel on prepayment, portability, and penalty calculations. Number 3, shop the market with the mortgage broker to get a competing offer. Number 4, use that offer to negotiate firmly, stating that their first offer is not acceptable. And number 5, make your final decision based on the total value of the mortgage, not just the interest rate. The next few years will see the largest transformation of wealth from homeowners to the banks in a generation. Don't be part of it. The renewal letter isn't a command. It's an opening offer and a negotiating you now know how to win. Don't pay the loyalty tax. Be proactive, be informed, and be ready to fight for the thousands of dollars that are rightfully yours. If you are a homeowner in the GTA and thinking of buying or selling real estate, use the link in the description to book a free, no obligation call with me. We will build a custom strategy to put you in the driver's seat. Until next time, see you soon.